There is general agreement out there among most of the pundits that I'm following that this is going to be an absolutely amazing year. The All In podcast, Larry, I was just listening to the All In podcast. They're making their predictions for 2026 and for GDP increase for 2026. They were between the four of them, they were between 4 and 6% on GDP increase. And of course, we had the
Is that a net or a gross?
that's the
Net of inflation?
annual increase.
Annual, so that's a gross. So it
Yeah,
includes inflation.
right, right. No,
So that number doesn't really matter until they specify what inflation level
that
they
would be
expect.
the real that would be the real
A
GDP.
real GDP. Okay, sorry.
Because we had real GDP just the other day in the GDP now, real GDP 5.1% based on the fourth quarter. So it's not unrealistic, but one of the, I forget, we might have been David Sachs, I think it was, who said, to put that in perspective, the only other major nation to have a 6% increase year over year would be China. And that would have been back when they were coming out of poverty into into
70s. Yeah.
Yeah. And this is
Late 70s.
a huge a huge economy, which going up 6% would just be astronomical. So Cathie Wood, yep.
Yeah, just a word or two about that. It's not a good indicator when all four come up with that number because traditionally they've been wrong in the past.
I see. Okay.
That's just an aside, and it's a joke. It's not.
Yeah, I get it. I get it.
But I will say this, that it wouldn't surprise me. I mean, before we get into what Cathie's thesis, which is a very strong thesis, but it wouldn't surprise me, taking into account that our real growth has been almost, getting to the negative point in the last couple of years. So, the early stage of the recovery is incredibly strong.
Mm-hmm.
What is more interesting, though, and that's what we're going to go into, is Cathie is looking for a longer term, higher growth in the longer term, which is really fascinating.
Yep. All right. Well, let's get into, first of all, just let me remind people what we do here, and that is Cathie Wood once a month comes out with her special report. She, of course, is the CEO and Chief Information Officer, CIO of ARK Invest, which she founded. And they really, really dig in super deep into multiple companies and then also into the economy. And so Cathie, once a month, she gives us her predictions and thoughts with regard to where the economy is and where it's headed. And then Larry and I, once a month, we take a look at what she said and we add our special flair. Maybe we increase the value of it. Maybe we decrease the value of it, but we'll let you guys decide that. So Larry, what do you think?
I won't tell people what we really do. But between you and me, we just dumb it down.
Oh, is that what we do? Okay.
I think we try and make it a little bit more accessible, but we also have our own spin on it.
That's
we
right.
don't necessarily always agree with Cathie. In fact, you're the one who's, normally the culprit.
That's right. I disagree more than you do.
So, Cathie prepares about an hour long show every month after, we get the actual labor statistics from the government. And this is our analysis of her analysis. And so we've borrowed very heavily from her. We try and explain what she's saying in our terms, and then we have our take on it, as you said. So let's dive into it. So this is kind of the high-level summary of it all. Cathie talks about a rolling recession paradox and the path ahead. And what does she mean about a rolling recession paradox? It means that if you look at the past 3 or 4 years, I've talked about a recession. I've talked about how bad things have been. But actually, the nation didn't actually show even one quarter of negative growth. They constantly showed a positive growth number. And despite that, Cathie says we've been in a rolling recession. The paradox is, it's a recession, and perhaps a better term would have been a selective recession rather than a rolling recession, because the recession has hit the housing, the auto, and the manufacturing markets very, very hard, sectors very hard, and the people employed in them have suffered very, very out of all proportion. And now we're in this trough where we have lower interest rates and AI-driven capex boom that Cathie says will trigger a broad-based economic recovery, that all of these areas that are so blighted will recover, and very rapidly. And so what she sees is a Goldilocks scenario, high growth, productivity-led, with low to negative inflation. And when we talk about negative inflation, that means deflation. A lot of people are scared about deflation because deflation, is historically extremely difficult to overcome. But this is not so much a deflation caused by a recession. It's a deflation caused by lowering costs, lowering higher productivity, dropping costs of production, and causing, lower prices, which is somewhat different to deflation. Does it all make that? Do you agree with all of that?
Yeah, so I think an example, I wish she would say it this way because I think, well, it's what I believe anyway. A great example is, of course, commodities, and we will, I think, talk about commodities later.
Right.
But commodities haven't gone up even in nominal dollars.
Right.
Commodities are the same as they were 40 years ago. Well, why is
Except for gold.
Except for gold and silver, right?
And copper.
But why
And
is
silver.
that? I said silver, yeah. So anyway, so why is that? Well, because extraction costs have gone down. Productivity has gone up with these mines and other things that we're extracting. And when you have the cost going down, yes, you could have a drop in prices, but in this case, what you've just had is a drop in the real price, even though the nominal price has stayed pretty much the same. So this is across the board in so many areas that we're seeing these kind of drops, and with AI and robotics, it's just going to get more in that direction.
I raised those exceptions for a slightly different reason, and that's because these generalities don't apply to every case.
Mm-hmm.
So what you said is broadly true, and it is reason for the general depression in the price of commodities in relation to all other production. But in certain cases, there are other extraneous issues that cause that problem. So
Sure.
I agree with you, but look at the numbers. Actually, it's pretty impressive. This is where we are right here, and we've seen this, this general decline in what amounts to the economic growth, economic activity, and look at where Cathie is projecting it to go. So it is, pretty significant in terms of, the potential in the economy.
Yeah, and one of the areas that she also doesn't cover when she talks about this rolling recession that I always like to add in is transportation. When you're building fewer homes,
Right.
when you have fewer durables being sold, when you have fewer cars being sold, all of those things take away from the trucking industry, which has been in a very bad recession now for 3 years.
Right, and when you have such gigantic sectors in the market, such as housing, in a decline, it drags a lot of other stuff down with it, which is why, in a way, which is the reason I think for Cathie's characterization of it as a rolling recession.
Mm-hmm.
By the way, this y-axis is what Cathie calls the momentum index.
Okay.
So this is the momentum, this is the rate of change, and
Mhm.
this is what she sees happening in the rate of change over the coming many quarters. Okay?
Yep.
So we see a strong GDP versus sectoral pains. This is the point I think you were making, that, manufacturing is down very significantly. The consumer index is somewhat stalled here at this point. Consumer sentiment, and
Mhm.
there are many ways to test consumer sentiment, but in general, this is where the numbers are right now, just at this point. And at 2024, and it's actually going down from 2024 to 2025. So it's stalled. Manufacturing PMI, this is really bad, but it's showing a slight uptick now. And Cathie believes that it's going to be, a sharp rebound.
Right. Well,
So,
you might expect a rebound anyway, because eventually people who overbought durables during the COVID period will finally wear out some of those durables, or
right.
need to replace some older ones that haven't been replaced. So you would expect the manufacturing sector to rebound on its own. But in addition to that, we've got this massive effort by the Trump administration to bring more manufacturing back to the U.S. And it takes a while. It takes a minute to build the building, put in the equipment, and get it operational. But Lutnick said this week that he specifically knows of 40 buildings that are under construction right now for new factories in the U.S.
Yeah, and this is why earlier this year, or sorry, mid of 2024, I took a fairly significant investment in, for me anyway, a significant investment in an infrastructure set of infrastructure companies. But, the manufacturing contraction is pretty big. It's
Yeah.
greater than 50%. And, we're looking at a slight rise into 2025, but as we'll see, Cathie's looking at, a very big jump thereafter. So we're in this point of pain, and the silver lining is that there's a sharp rebound coming.
Right.
Okay, so the housing crisis. I mean, wow.
Yeah.
I mean, we're seeing, a crisis which is actually greater than the crisis we experienced in 2008, where 2009, 2010, where we were in a great, the great financial crisis. Housing sales are down 35%. And here we are in 25, small recovery, but Cathie's looking at some huge rise in 2026, which, speaks very well. And then the crisis is really because interest rates have risen very dramatically. People can't sell their houses. We have a lock-in effect, but she foresees the rates falling to 4.5 to 5%. Millions of locked-in homeowners will finally move, unleashing a massive wave of transactions in 2026.
Yeah, so as we talked about last night on our show, Larry, we had this dramatic effort by the president to buy up mortgage bonds, which immediately, within hours, changed the interest rates from about 5.2, I'm sorry, 6.25 down to 5.99. If we get another 100 basis points off at the Fed, I think we'll see that 100 basis points actually translate more reliably to mortgage reductions. So we could see later this year a four handle.
That's right. I mean, a lot of this depends upon the actions of the Fed and the actions of the government. Some programs ago, you and I were talking about interest rates, and I said the Fed is programmed to stop buying up mortgages at the end of the year, and that will take some pressure off the interest rates. Well, I was completely wrong. because even though they were slated to stop buying mortgages, they've started to buy loans from the banking sector itself. They call it balancing or whatever it is. And so, we're going to see still some pressure at the high end of, at the low end of the curve until the Fed stops us. The Fed has to learn to get hands off. The Fed has to start stepping back. And it's just, they find it very difficult to. And the current explanation of why they're doing it doesn't make a lot of sense to me, unless it's a way of easing off from the point at which they were buying.
Yeah, and people
selling. Sorry.
Yeah, and so this is impacting both new homes and existing homes in terms of this selling recession. And what folks don't think about often when they think about homes being built, it's not just about lumber and concrete. It's about electrical sockets. It's about plumbing. It's all kinds of things that are manufactured. So when houses aren't being built, then it impacts the manufacturing economy as well. And as I mentioned, it also impacts transportation. So you have, as you said a minute ago, Larry, it impacts more broadly the housing, which is 30-something% of the CPI. It impacts across a whole bunch of categories.
Yeah, but if you take the housing market and the manufacturing market and both are in recession, you have a very serious problem because it impacts so, just so broad in the economy. And I think that's the essence of the rolling recession.
Exactly.
But Cathie is very hopeful for the breakout from manufacturing and capital expenditure because of AI and the reshoring drive investment.
Right.
And part of this is the tax changes in the tax that this administration has implemented and Congress enacted, or this administration requested Congress to enact, and they did. And so we are seeing, what Cathie sees as a huge rise in manufacturing construction.
Yep.
So go ahead.
No, that was it. Yeah, I agree with you.
Yeah. So we see a massive productivity surge that will come out of this expenditure, and as the manufacturing construction spends goes up, and of course a lot of this is data centers, and we'll talk about innovation and what it's going to bring, but the thesis is it's going to bring a huge amount of efficiencies everywhere in the economy. And so it'll have more than just an impact on the expenditure on the infrastructure itself and the expenditure on the industry itself, on industrial production itself, but also in efficiencies of labor.
Yeah, and I'm not in any way the first to say this. So many people have said it before me. What we're going to see is that these new manufacturing facilities, these new companies, are people that are starting pharmaceutical companies that are building brand new factories. These are going to be practically lights out factories. These are going to be factories that are going to be so automated that you may not need any human participation at all. One of the programs the other day, I think it was the second moonshot program the other day. These guys had taken a tour of the factory, the new manufacturing facility for Tesla down in Texas that will build the robots. And he says that even before the humanoids build humanoids, the line was so automated there was barely any humans except for moving dials.
It's interesting. I want to comment on that. I know a lot of people talk about, how automated these factories are, and they are. The Tesla factory is dramatically more automated, say, than the BMW factory, and I've been in both of those factories. You just see so many more people in BMW than you see at the Tesla factory. But nonetheless, Tesla employ over 100,000 people.
Right.
So these things are relative. These things are relative. Sure. So then we look at manufacturing and capex in this slide. And we're talking about the reshoring drive development investment and the AI investment. And we're looking forward to, this massive rise in construction spending, manufacturing construction spending. We see the shift while traditional manufacturing is contracting, construction of new high-tech factories, chips, EVs, batteries have gone parabolic. And this capital expenditure boom will translate into massive productivity surge as these factories come online in 2026 and 2027. Again, a little word of caution. Not many people understand how much time it takes for a manufacturing operation to get up to speed and then to translate that to revenue. It used to be a 10-year process, then maybe a 5-year process. Today, it may be a 3-year process. But for those of us who know Tesla so well, the levels of expectation of production always are dramatically higher than actual, results show. So, it's just something that's very difficult to understand or appreciate. So just a little word of warning. And, I'm not sure whether Cathie has measured that out, perhaps in time, as accurately as perhaps she may.
But you also, Larry, we
Let's go
also
back.
got to take into consideration complexity.
Yeah.
So it takes a long time to get into production on a car, but it doesn't take as long to get into production of a pharmaceutical. If you already know the chemistry on the pharmaceutical, you've been making it forever in China or in India, you already have the chemistry. Yeah, you got to put all the equipment in, you got to dial them in. But once you put the line, which I've seen these lines are not complicated. The lines have been around for, completely automated for a very long time in terms of dropping the pills in the bottles and or making the
I'm going
pills
to
and then dropping
challenge
the
that.
bottles.
I'm
Okay.
going to challenge that.
All right.
I'm going to challenge that because most of the chemistries of today's pharmaceuticals are actually quite complex. Many of them require a fermentation process. Most of them require a fermentation process. That is a very, very difficult process to dial in accurately and get pure. The purity of these pharmaceuticals are very critical, and the quality testing on them to get to the levels of purity and the levels of accuracy that they require is not as simple as you make out. So yeah, it looks really simple. A couple of big tanks, a few valves, it looks like it's nothing. Believe me, it's not nothing. So let's agree to disagree. We'll see what
Okay.
happens.
Okay.
So consumer sentiment is really not good at the moment. We're as low as it was in the global financial crisis. The University of Michigan sentiment is, despite low unemployment, consumer sentiment is bad as the great financial crisis. And the cause of cumulative effect of inflation and high interest rates has crushed purchasing power, especially for youth. But I will say this, there is definitely a complete nationwide comprehensive recession for low-income folk. So low-income people have felt the effects of this selective recession far more than any other group of people.
Yeah.
And I suspect that that's the reason that right now the Democrats are looking pretty darn good in the run up to the election of the end of this year. So I would just caution that the consumer sentiments are really related to the recession that is so selective to those low income earners.
And I think Cathie was the first to point this out, and both you and I glommed onto it immediately. And we've been talking for 2 years about the difference between the under 100,000, that don't own assets and the over 100,000 that do, in those two groups, how disparate the results were, in particular under Biden, when Biden this inflation thing was out of control, which is always going to help the asset classes, as opposed to those who don't own assets. So that's turning around. I heard some pundit yesterday say that the problem for President Trump is that he doesn't care about the working class, but in fact, that's exactly who he cares about. And it's exactly who he's trying to help right now by reducing inflation and by bringing manufacturing back to the United States.
It's the paradox of socialism. Socialism is all about trying to help those people in the lower classes and to normalize normalize us into a classless society. But the policies always hit those people at the lower end of the scale very much harder because there's so much less that they have, in terms of the margin. But, having good jobs at good salaries and the ability to save that money and not have to have, the cost of healthcare. I mean, healthcare as a whole, it's my hobby horse, but the policies that we've had on healthcare and in essence, Obamacare has really hit those people at the lower income levels far harder than it has anybody else, even though it's hit everybody very, and it's very seriously impacted them. Anyway, I'll get off my hobby horse, but yes, we are in crisis levels, and sentiment is at the lowest it's been since the global financial crisis.
Now then,
and the question,
I'm sorry, go ahead.
Yeah, the only question is whether what is in train now will happen in time before the elections of November this year.
Yeah, and to put this in context just a little bit, I've been complaining about the University of Michigan sentiment report for at least a year because you can hear their sentiment. You can hear the University of Michigan's sentiment in the words that they use in their report each month. And you can tell, and without being partisan at all, it's a liberal report. They are definitely talking about it from the standpoint of people that have a dog in the hunt. Then Cathie points out yesterday that their numbers now is, what was the split, Larry?
70%
Democrat.
From the Democrats and 30% from the Republicans. So it's not a survey at all.
Yeah.
It can't be a survey if 70% come from one particular political persuasion, because it is such a political animal, a consumer sentiment, so we're taking a sentiment from those people who are, opposed to the president. So it's a very poor measure. And I don't understand why the bias became so, and what's interesting is we've always believed there's a bias. Now we actually have the numbers for the bias. And these numbers have crept in over the last year or so because it was traditionally 50-50.
Yeah.
So I don't know the reason for that change.
So I'm starting to look at these sentiment reports, especially this one, as a trend-only report. I'm not taking anything away from it in terms of how the world is actually being perceived right now, but it at least gives you trends. And if the trends in this particular case are headed higher, that's a good thing.
Yeah, the only thing I'll say about that is the trend is going forward. You can't actually look too far back because of this. We don't know the change in how they were sampling, at what point it took place. Anyway, so the inflation thesis, why does growth equal lower inflation? And so Cathie took a lot of pains to show the productivity deflation mechanism. So she starts by saying the misconception is that traditional economics say stronger growth causes inflation, so-called Phillips curve. Cathie says this is wrong when we have an age of innovation, because the reality is that AI and robotics are driving massive productivity gains, massive productivity gains. We talked about the factory in Austin and how they've mechanized that. When output per hour rises, unit labor costs fall, leading to lower prices even when wages rise.
Right.
So if wages rise at the same rate as productivity rises, then what's going to happen is that even though wages are rising, prices become lower and lower as that productivity rises.
Mm-hmm.
And so the result is we're entering into a period of good deflation, where technology makes goods and services cheaper, boosting real purchasing power. We learned in Economics 101 that deflation is always worse than inflation.
Right.
But actually, if you look at the periods of the greatest growth of all, we've had tremendous deflation during those periods of growth. And I'm talking about the 1890s, for example.
Mm-hmm.
So yeah, I mean, productivity versus unit labor costs. And we see it in action right now.
Yeah, and it's easy to get confused on this subject because sometimes you get shortages. Something becomes very popular and then you can't make enough of it. Even though you're making more and more and more of it, you're still not making enough. Ozempic comes to mind. So Ozempic became very, very popular, and all of a sudden it's $1,200 a month because there's not enough of it. Then there's a point at which that curve levels off, and now Ozempic is down to you can get it for $200 a month or whatever because they finally making enough of it. So it's hard. Sometimes this curve looks cattywampus until you get over the hump, so to speak.
Right. Very good. Okay, so the path to 5% plus growth, echoes of the 1990s internet revolution. So in the 1990s, when the internet, was introduced, we had this enormous boost of productivity, and we had this relatively brief period of massive growth. And, this was also the period of the Clinton, Gingrich partnership, which was so productive and really was the greatest realization of the Reagan Revolution we had. And she sees quarters now with 5 to 6% productivity growth in 2026, reminiscent of the 50s and the 90s boom. And the driver will be the convergence of AI, robotics, energy storage, creating a super cycle of efficiency, dwarfing the internet era. And I don't think we yet understand all of that, all of what's going to happen, and, I don't, it's very hard for me to understand the secondary and tertiary effects of these enormous technology revolutions. And sometimes those are the most surprising and the most productive and the most interesting yielding. But in general, if you look at what Cathie sees, is she sees how she interprets the economy. She saw the 1950s boom, which was a productivity boom through the industrialization, post-war industrialization. The 1970s stagflation, came off the gold standard, and we started pumping money into the economy at enormous amounts, at enormous rates, producing this gigantic inflation rate, leading to a stagflation.
And exacerbated by the oil crisis.
Absolutely exacerbated by the oil crisis. The 1990s internet, the 2010s stagflation, and then the 2026 AI boom. So it's very interesting. Very interesting.
Yeah, and I will say that I did. I have a tendency, Larry, my entire life to predict things way too soon, and then they still come true. 6 months later, or a year later, or 2 years later. So people can look back, and I said I thought the productivity boom would hit us in 2025, and I was only 6 months off because the third quarter we saw 4.7% productivity. So this is it took 6 months longer than I thought it would. And I think a lot of that has to do with what Jeff Lutz said on my show a few weeks ago. He says only 1% of manufacturing has even incorporated AI yet. Elon Musk said, we haven't used AI at SpaceX yet. So it takes a minute, before people can actually take the newest stuff and incorporate it into their manufacturing lines.
Well, manufacturing generally is the last to benefit.
Right.
It starts at the services level and then gradually makes itself, because we have to rebuild, we have to tool up, we have to change tooling. It's a very slow process, and even 6 months, you may still be premature, because this productivity blip in one quarter is not necessarily, I don't say it's not, but it's not necessarily an indicator of what's to come. But you're right. I mean, we in general in economics, we tend to forecast ahead of where we are, because we it's very hard to understand the time these things take to happen.
And there's
I
another
tend to be on the other side of this. I tend to be more pessimistic than actually I need to be.
That's why we're such a great balance, Larry. So one quick additional thought on this has to do with the federal government laying off 277,000 people. Nobody. I mean, I read article after article after article, and I think I've seen one article so far that talks about the fact that 277,000 people have been laid off by the federal government, and yet we're still at 4.4% unemployment. And not only that, those people have become productive. As opposed to
they haven't yet become productive. The people laid off are unproductive. The people who have not been laid off have become more productive.
I'm talking about the people that have left government where they were unproductive.
They haven't yet, because they haven't yet got jobs.
Well, a lot of them do. So that's kind of my point.
They're living off the what they got from the government for. I mean, you'll see what you say is partially true, but the real impetus of their productivity is still to come, in my judgment.
Yeah.
So I think we've got a ways to go.
So Larry, the opposite of unproductive. So in other words, if you
the opposite of negative productive.
Exactly.
It's not unproductive, it's negative productive. They're a drag on the economy.
Right.
They've been a drag on the economy. That's absolutely true. That's absolutely true, and that's an instant impact.
Right.
My question is when do the state governments start laying off? And here's when it happens.
Yes.
When the effect of Doge and the effect of the realization of this gigantic grift with federal dollars going into these states that, are using this for political purpose, are using this money for political purposes, when that gets tied down, then we will see a tertiary effect of the government turning into a greater surplus, and B, those unproductive people who were a drag on the economy having to be let go, and becoming productive. And, it's going to work itself down to the local levels. Last election was the first election that the town of Cary in North Carolina turned down a bond effort. And we are such a wealthy town. We have huge surpluses. Yet they've doubled our tax. In the 10 years that I owned a house here when I owned my last house in Cary, they doubled taxes, literally doubled the taxes in 10 years.
Wow.
And that came after they had doubled taxes in the previous 10 years. So, they had literally quadrupled taxes in a 20-year time frame. And the town of Cary, we don't have enough places to spend the money. We don't. We have such great services. We have such a great environment that where can they spend the money, and how they spend the money? New parks. Why? Because it's almost there's an infinite way you can spend money on new parks. So all of that stopped now. So you're going to see a reversal of that whole trend. So yeah, I mean, talk about productivity. And by the way, the city manager of the town of Kerry was just fired. Why?
Oh,
Because of the amount of expenditure on luxury goods, on conferences, went to a conference. Everybody else stayed in a middle priced hotel. This great mucky muck stayed in some ultra luxury hotel at $1,000 a night and so on. So bottom line is, yes, you're absolutely correct. I stand corrected. So interest rates. The forecast is we're going to get back to normal. I'll believe it when I see it, Cathie. No, seriously, they will fall back to 3%.
yes, I think so too. We're talking about the federal Fed rate.
Yep. And I think it's time, and I think it'll happen. And then we talked about
By the way,
S&P
Larry,
ratios.
I think we sped past that. Can we go back?
All right, let's go back.
Okay, so what the Fed has been getting wrong all along, and I'm sorry to put myself in a position of saying that I know more than the Fed, but the Fed rates control things like car interest rates, credit card interest rates, personal loan rates, regional bank rates to industry and to local property. And those are the things that were being impacted the most over the last, except for housing, which is the 10-year bond. But all of those things are impacted by the Fed, and they've been dramatically affected. So as these rates are coming down, it takes a minute, it takes a quarter, it takes 2 quarters, but we've already come down 125 basis points. It's I think we'll begin to see the impact of the Fed rates cutting in the first quarter of next year.
I'm aligned with you 100%. 100%. So S&P ratios. So this is the S&P ratio of how the S&P is priced versus oil, and how the and so this is a leading indicator. S&P to oil ratio heading for new peaks, mirroring the setup for the 1980-2000 bull market. And the gold ratio, Cathie believes it'll follow the oil ratio higher, not collapse like the 1970s.
Yeah, that's the interesting one. The gold one is the one that's got gold and bonds have me a little bit confused, but the oil thing, is fantastic, and I don't see it changing. There's so much oil.
Yeah, the question is, when does gold become so much gold?
Yeah,
In other words,
right.
when does the mining of gold catch up to this increase in price and bring the supply up and moderate the price? That one of the things that sorry.
Go ahead.
One of the things that none of the pundits have actually talked about is that gold is not as an elastic a commodity as many other commodities. Now that the South African mines are mined out and there's no gold left in South Africa, that swing producer doesn't exist anymore. And so what we're seeing is gold reacting in a way that it hasn't reacted historically, certainly not for the last 100 years, because in the last 100 years, the South African producers have always been able to pump up production when the prices rise, or that they've automatically pumped up production as it rose. But in the last 10 years, in the last 20 years, really, they haven't had that facility. The gold has run out, or the gold that at moderate cost levels have run out. Because the gold in South Africa is really like a saucer at an angle, and it sort of there's a reef that sticks out of the ground, or sticks right up into the ground in Johannesburg. And so once you've mined the gold close to the surface, and then you gone deeper and deeper, and now they've got to what they call ultra deep levels, 10,000 feet under the ground, I think it is, if my numbers are correct. That's 3,000 meters or so. At that point, it becomes, challenging from an engineering point of view, but also incredibly challenging from a cost point of view. But at $4,000 an ounce, it may not be that challenging, and they may be able to swing it, but it'll take a lot of work to get there. Firstly, they have to reopen the old mine. Secondly, they have to create new drilling technology, and so on and so forth. So unlike oil, which is incredibly rapid, you can tap a new oil source in as little as 3 months. Sometimes it's 6 months, sometimes it's a year and a half. But it's not the 5 and 7 year cycles that you face in opening a new major gold mine.
Yeah.
So, and the other thing is it's an enormously risky investment, taking 5 or 7 years to open a gold mine based upon the sudden pop of the price. So the price of gold is not that elastic. This is just some local knowledge that I wanted to pass on.
Yeah, and the other side of gold is that it's not really something that's used in industrial use. So where silver and copper, which are at all-time highs, there's industrial use for both of those. And right now there's a shortage of both of those with regard to the demand. With gold, there's hardly any industrial use. It's 100%, almost 100% a storehouse of value. And so what's been happening, we've been watching this, Larry, week after week, month after month, is that we even have Costco selling gold bars, and they can't sell them fast enough. So you've got consumers in South Korea, in China, even in India and in the United States buying gold as a storehouse. You've got some countries like China, and quite a few of them actually, quite a few countries that have been increasing their Fort Knoxes in terms of the amount of gold that they're putting aside. So I think there could come a time when Trump will reset the valuation of gold, and that's going to have a big impact.
Why would it affect the price of gold?
Because right now the United States has the gold in Fort Knox, or the gold that the United States holds, is sitting at some ridiculously low number.
But that has no impact on the price of gold. That has an impact on the Federal Reserve reserves, and nothing else.
Well, well, I should go back and study more. But there is a
well, I think all the studying in the world is not going to help. I honestly think that the nominal price of gold at which the United States recognizes its reserves of gold has nothing to do with the market price of gold, which is completely independent. So I think the one has nothing to do with the other. Now, your argument about the BRICS plus using gold as a store of value is really a good argument, and it's a difference. It's the first time in 50 years that we see gold being seriously considered as an alternative to the dollar. But here's my prediction. Just as in 1980, the price of gold went through the roof and into the solar system and collapsed shortly afterwards, it's going to collapse. And when it does collapse, those countries that have turned to gold as a store of value or as a reserve currency are going to be very, very badly hurt. That's my prediction.
I couldn't agree more, but I thought it was going to happen last month.
These things don't happen in week cycles or in month cycles. They happen over a period of multiple months. If I were to make a prediction, I would make a prediction of sometime in the next coming year or so. That would be my prediction.
Okay.
Cyclical turn. So copper signals a global recovery. I know you think people use copper for other purposes, but they don't. Copper is essentially an industrial metal, and it represents essentially industrial activity. And industrial activity electrical, generation, storage, and transmission is really where copper's huge usage is. And there's never been a period in history since the railroad revolution that energy is in greater demand, or the quantum of energy is the demand for this level or this quantum of energy has been in place, and it's going to be quite a long cycle.
Yeah, I don't have any argument, Larry, at all with regard to copper being used in any other way other than right now there is industrial hoarding. And we talked about this last night. It would be wise for companies that use copper in their production, they can't be caught short. So I would
I
be
think
hoarding
most of the
copper
hoarding
too.
is
Yeah.
I think most of the hoarding that you call hoarding is being done against actual orders that are spun out by a year or 2 years or 3 years, because production capacity is far less
Yeah,
than orders on hand
right.
in the electrical generation or energy generation environments. I mean, I know, for example, that generators, steam turbines, are out 5 years right now in terms of production. So if you have a magic way of creating a steam turbine, you should do that now, right now, because they're worth gold,
So to speak.
so to speak. And so you need copper. You need to order that copper now
Right.
against that expectation because of the price, and B, demand.
Mhm.
So demand begets demand. That's the nature of it.
Right.
And this is entirely different from the gold demand.
Oh, yeah.
It's,
Oh, yeah.
it's entirely different. So the hoarding that you have right now is hoarding against actual industrial use. Hoarding that you have in gold is entirely different.
Right.
It is this reserve story.
Mhm.
So we should see, this play out over the next couple of years. Credit markets. Public markets are healthy, private markets are worrying. So in public markets, we can look at, the spread between high yield, that is poor credit, versus good credit. Not much, there's no stress. The high yield market, people with less strong credit are not going bankrupt.
Mhm. Mhm.
Privately, though, there's been an enormous amount of borrowing in non-bank markets because banks have stopped serving private people.
Right.
The banks have just stopped serving private people.
Right.
You either buy credit card debt at 20% per annum, or you don't get credit.
Right.
It's ridiculous.
Yeah. Yeah.
I think Congress should step in, or the president should step in, and they should limit credit card debt interest to 11% or 10%. That's my view.
So I'm going to probably do an entire story on that later today, Larry. Maybe you want to join me. I don't know, but I wanted to know. I asked Grok because I had a pretty good idea what Grok was going to say, and there was a few things I didn't know. But basically, you're talking about when you reduce credit card down to 10%, the credit card companies literally cannot make money at 10%, except on their very, 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 very best customers. And some of their very best customers never pay any interest at all because they pay it off every month. So you've got this problem of how you get the credit card interest rate down to 10% and still serve customers
Credit cards should never serve customers. Customers should be served by their banking relationships with their private bank. Banks should be serving customers. And the banks have been, they've been outlawed from lending to private consumers because the levels of protection that they have to put in makes it almost impossible from a financial point of view to serve private consumers.
Mhm.
So what we need to do is reform the system. Private consumers should be able to borrow from banks a reasonable amount of money related to their income and their credit performance.
Mhm. Mhm.
Credit cards should not be the source of debt,
Right. Oh,
the source of liquidity.
yeah.
Banks should be the source of liquidity.
Right. Right. No, all I'm saying is that there are the question that you just raised and the question that the president has put on the table, which I think he's going to use jawboning. I don't think he's going to actually get Congress to get this 10% thing across. And I
Doesn't
think
need Congress. He can force it without Congress.
Yeah, I don't think he can force it, but I think he can do what he did with the pharmaceuticals. He can go to the banks and say, you bring them down to 10% or. I mean, I don't
No,
know that he has,
banking regulation is literally done by the Federal Reserve
right.
and
But
the banking.
Can they cap interest rates?
Yeah, they've done
Oh,
it in the past.
okay.
They've done it in the past.
All right.
They did it in the global financial crisis. They've got such enormous power that, you know, you talk about jawboning. Most of their power is jawboning.
Yeah.
So, I mean, maybe I'm wrong, but I don't think I am. I think the president could do it. Now, the president doesn't control the Federal Reserve.
Right. Right.
But the Federal Reserve, you know, they can be jawboned. Anyway, it's complicated, but my God, we need reform in this area. If anything needs reform, is the private markets.
Right.
Why do private markets exist? Because banks have stopped banking
Right.
for retail customers.
Mm-hmm. Mm-hmm.
And they have to start banking for retail customers. This credit card debt is completely insane. Anyway.
Yep. Mm-hmm.
So, you know, this is high yield credit spreads. It shows that there's no pressure in the economy. There was, of course, back in 2020, during the crisis, the COVID crisis. And then, you know, dropped to 2021 when Trump paid out all that money. Biden paid out all that money, went back up again when that money was spent, and now it's going back down. All right, so the Goldilocks scenario. So, I mean, this graph is really, I hope people understand what it is, but right now, where we are, if we look at zero to best in this graph, you know, we're only halfway up at GDP growth. We're a little bit lower at inflation. We're driving up at productivity. Our real wages are just short of halfway up to sort of the target. Corporate profits are looking pretty darn good, and innovation's going off the clock. So Cathie sees, you know, all of these things reaching their pinnacles, their peaks of capability. So this is where we are, you know, which is, you know, not that great. And this is where she thinks we're going to be. So the big issue is for real wages, which are almost as low as inflation, but it looks like they could drive high and inflation can drive low. So inflation is kind of inverse in this graph. Anyway, I hope people get what I'm trying to say in the graph, because it's a little difficult to get across the breadth of what Cathie's seeing in terms of what's coming.
Yeah, and this is we've talked about, you know, the Goldilocks thing over the last year, because we've commonly been hit with like, okay, this is a Goldilocks scenario. What's going to happen next? And then there's something that pulls the rug out from under. But I think
it's time.
It's time. Yes.
So the point is, in economic forecasts, I've said this so often in our conversations, in economic forecasts, we always see the future sooner than it's going to occur. We always do. I mean, it's the essence of human expectations. You know, you don't see the size of the future in perspective.
Yeah.
You see it closer than it is, you know, and things in the rearview mirror look closer than they really are.
Yeah. And Larry, I want to drop back a minute on the productivity thing again.
Okay.
Because, you know, it's such a hobby horse of mine. But my predictions last year that I was too early on had to do not only with the government's layoff of the people, but it also had to do with companies finally laying off that extra labor that they were hoarding because they had just gone through a time when they couldn't find any labor. And
I don't
all the
think that's
reports,
done. I don't think that's done yet. I think it's still happening.
but we had a lot of layoffs last year. All the charts are showing we had a lot of layoffs, but people are calling it like the jobless the jobless economy. It's a good economy, but it's jobless. And what I'm seeing is, yeah, we laid off some of that stuff that we really didn't need, and that was part of this 4% increase in the third quarter. And I think, as you point out, that's going to continue. And then you add
And
up.
my argument is that it's not so much that we finished laying off those people that we overhired. It's just that many of those people we overhired are becoming productive now.
Oh, there's that as well. I would agree with that.
Yeah, I think that's the essence of it, because my analysis of the numbers show that we haven't laid off anywhere close to all the people we
Added.
hired unnecessarily. Anyway, here's the whole. Oh, I lost my little blocks here.
Uh-oh.
These are supposed to be little squares, and
Okay. All right.
I guess I lost them. But anyway, this is Cathie's roadmap, I think.
Okay.
This is how I interpret it anyway.
Okay.
Q1 2026, housing bottoms, inventories clear, and the Fed cuts rates aggressively. Maybe not as aggressively as they should, but they should. Q2 of 2026 is when the turn happens. Manufacturing PMI breaks 50, housing sales surge, consumer sentiment rebounds. Well, I hope housing sales surge, because my brother's going to be selling his house in the second quarter.
Well,
I sold my house last quarter.
Yeah.
Because I moved to this retirement village, and now my brother's moving next door to us.
Okay.
And so he's selling his house next quarter. And I told him he's selling it into the best market we're going to have in like years. We'll see. And consumer sentiment rebounds. I think that'll happen.
Well,
I'm aligned.
Cathie points out, and I know you and I have pointed it out a dozen times already, but many people may not have heard us point it out before. There's going to be a 1% of GDP stimulus coming from the one big beautiful bill hitting in the first quarter and into the second quarter. So when all those federal tax returns come in, and when people change their withholding, and when companies also change their quarterly numbers around the new law, the new rules, this is going to be, some people are predicting as much as 1% of GDP that's going to hit in the first quarter.
From your lips.
Well, it's going to happen, whether it's 1%.
Yeah, well, there are a lot of things that happen in the economy, and the interactions are very complicated. But I think you're right. Q3 2026, the boom. Productivity hits 5%. My gosh. Real wages rise. Good deflation takes hold. 2027 plus, the golden age. Innovation platforms scale exponentially. These are just 3 of the 5 she mentions. But here's my prediction. Quarters may turn into years. Quarters may turn into years. That's maybe year 1, year 2, year 3, year 4. So a lot turns on the elections in 3 years' time. 2 years and 3 quarters time. There's very little time left. A lot turns on that. As we see a continuation of this. But the good thing is, very often when policies are in place, it takes a long time for a changing government to reverse them, as we've seen.
Yes, yes.
Well, here endeth the lesson.
Okay. Well, I think, as always, because I'm an optimist, I think it's going to play out very much like Cathie says. But I think it's because there's going to be, as we've talked about a lot this year, a confluence, a convergence. We're going to see all these things happening at once. And it's not necessarily even because the president planned it that way, but maybe he did. But we're going to have the tariff impact coming off of price. We're going to have the performance of this productivity that's going to reduce the cost of products even more. We're already seeing that trueflation is under 2% at this point on their estimate of where the inflation is right now. And that even counts services inflation going down to close to 2%. So these things are already starting to take place. And then if that translates along with the tax cuts into people having a lot of money in their pocket and interest rates coming down, I mean, this combination is pretty unprecedented in terms of the potential.
I agree. I don't disagree. I think that the opportunity, that all the signs remain good, are good, and remain good, and time will tell.
All right. And as always, we want to encourage people to go back and look at Cathie Wood's original report and look at her ARK reports during the month as well. She's starting to have a newsletter now, I understand, Larry. And
Yeah,
so
she's going to be writing a letter, and we have the huge, annual big ideas report coming out, and that's going to be very exciting this year. I mean, I think that this is a group of very bright people, and they do such great work. So I'm very excited to see that.
yeah, so you may want to follow Cathie or follow ARK Invest on X, or you may want to find out if you're not already on the email list. You may want to, I'm not exactly sure how you get on the email list, but probably
Oh, it's very easy. You go to the website and go to the website. On the front page, there's a way to click, and there are many different lists. It depends on your interest, whether you broad interest or your specific area of interest. And the materials are, it's just outstanding. That we can get that stuff for free is incredible. I mean, it's incredible.
Yes, it's true. Larry, as always, thank you for putting together the slideshow. Thank you for participating and helping out with this report each month.
That's why I get the big bucks.
That's 100% true. The check's in the mail. Thanks, Larry, and to all of you out there. It's been great talking to you.